Hello. Now let's go through the Akorfa Limited Group financial statements and use that to prepare the consolidated statement of cash flows. Now, you have to understand that we are preparing the cash flows after the consolidated statement of financial position have been prepared and after the consolidated statement of profit or loss has also been prepared. So all intra-group adjustments have already been done. Any corrections that need to be made have already been made. So bear that in mind. This is a consolidated financial statement we are working with. Right, so we have the 2017-2018 assets, equity, and liabilities. And take note of your assets. PPE, goodwill, investment, we'll come back to it. Now the footnote, you have profit or loss. The footnote tells you there were no disposals of PPE and no acquisition. Depreciation, there were no disposal. And depreciation charge in arriving at profit is 1.8. Now, Akorfa Limited acquired 90% of the ordinary shares of Anipa, so there was acquisition in the year. The cash consideration, 460,000 plus 1 million shares issued at a deemed value of 3.6. Net assets acquired. You have been given PPE, inventory, receivable, cash, and cash equivalent payable. So your net asset is 3.4, 3,400,000. Akorfa Limited made no purchases or sale of investment in the year. The group policy is to value non-controlling interest at proportion share of net asset acquired. Now, point 3, finance costs include interest on loan and gain on held for investment. Now, let's do this. Interest on loan, finance cost from the statement consolidated. Finance cost from consolidated statement of profit or loss is 450 finance cost. And we are told this figure is made up of the interest on loan and gain on held for investment. Now we know the gain for held for investment because the opening held for investment is 1,008 and the closing held for investment is 2,002. That's what I'm talking about. And the current asset, this held for investment, that's what is being referred to. It's 1,008 and 2,002. So there is a gain of 400. So if we have a gain of 400 and yet we have a finance cost of 450, then it means the interest expense, the finance cost interest on the loan is 850. Interest is 850. How? You must have 850 interest, which is negative, and then a gain on the investment of 400 for you to get 450 negative as finance cost as reported in the profit or loss. So that's how you arrive at your interest on the loan. Right. Now that we have cleared this, let's now walk through the question and make some thinking through. Now your asset, your PPE, acquisition or disposal will go to investing activities, but the depreciation associated to PPE will go to operating activity. Goodwill, the movement in goodwill is because of impairment. Impairment reduces the value of goodwill, and therefore that impairment will go to operating activities. Investment in associates. Now, investment in associates, again, you determine the whether they made any payment in cash or not. So you prepare a T account. PP, you prepare a T account there. Goodwill, you prepare a T account. Yeah, I will prepare T account for everything. Then inventory and receivable will be in operating activities as working capital management or changes in working capital management together with payables. Together with payables, you treat them under operating activities as working capital management. We have discussed held for trading investment. The gain has already been included in the profit, and this gain is non-cash, so it must be deducted from profit. So we deduct it from profit. Your cash and cash equivalent, the movement here 4,100,000 at the beginning and the closing is 1,400,000. So there is net cash outflow of 2,700. 2,700. This tells you that before you even start answering the question, you know how much, what your answer should be in terms of after preparing your consolidated cash flows. You should have a net cash outflow of 2,700, and just by preparing a T account of cash and cash equivalent, you get that answer. Then you come to equity, movement in equity, ordinary shares, T account. Capital surplus, there is no movement. It was 400 at the beginning, 400 at the closing. Retained earning, there is movement. So everywhere you see a movement, you actually have to determine whether there is a cash element to that. And then NCI, same. You prepare the T account to determine the movement, whether there is cash or not. Your long-term loan, 18 to 14, it's a reduction in the loan. So they have paid cash out. Like I said, payable will go into working capital management, and income tax will also be displayed on the face of operating activities. Now, it's important to note that the ordinary shares, retained earning, NCI, long-term loans, all these will be reported under financing activities. So take note of that. Now that we are clear about where our figures are coming from, now let's go in. Now in your profit or loss, you will start with the profit before tax. Now that's what we have, so that's what we use. In the event that you are giving profit before interest and tax, then you are better off using the profit before interest and tax. It only means your adjustments will be fewer. But when you start with profit before tax, then you have a lot more adjustment to be made in terms of the finance cost, which will include the interest and then the other income from the gain of held for investment. Everything that is before the profit will have an adjustment to be made. So that's what you, you have to take note of. So let's see how all this will play out. I've prepared all the T accounts, so we'll go through them and then we'll see. So your consolidated statement of cash flow. Now, like I said, we are starting with profit before tax, which from the question is 1990. You have to hold your question whilst we are going through this. We were told of depreciation, which is a non-cash item, so we add back. What does it mean? It means this profit, to arrive at this profit, depreciation was deducted, and we are saying that depreciation shouldn't be deducted because it's non-cash, so we are adding back. Same with impairment. Now, impairment of goodwill, you have to prepare a goodwill account to determine the movement. Now, I have explained, if you just look at the goodwill figure, the opening goodwill and the closing figure, you are going to conclude that there is increase in goodwill by 500, but that is not correct. Your opening goodwill is 24. Now there is goodwill from the new acquisition, which you have to calculate from with the acquisition figures. So here you have your cost of investment because you are calculating goodwill. You need to know the additions to the goodwill account through acquisition. So the cost of acquisition, cash and shares. So cash 460, shares 360. And then NCI is a proportion, so 10% of the net asset 340, and then the total net asset acquired is 34. So the new goodwill from the acquisition is 1,000. You add it to the existing goodwill, and then you compare it to the closing balance, which is 2,900. What it means is there is impairment of 500 which has been charged, which has already been charged, which has been taken out of profit, and we are saying under cash flows that is non-cash, so we add back. So we add back non-cash impairment, and then share of associate profit. Now, this profit includes the share of associate profit is increased by the share of associate profit, but the share of associate profit will have to be reported under investing. So you take it out so that I can go and report it under investing. So we deduct the share of associate profit from the profit. Then the gain of on held for sale, like we said, it means it is included. That 400 is included in this profit, and we are saying it is non-cash. Then interest on loan. Interest on loan will be added. It has been deducted from this figure. The interest on loan has been deducted to arrive at the profit, but we are saying we have to show it on the face of the operating profit as the last item. So again, we add back. How did we get the 850? I did it before we got here. So you go back to the beginning of this recording. Then you now have movement, change in working capital movement or change in working capital movement or change in working capital. So you prepare a T account for inventory, receivables, and payables, and then you will bring them in. So let's see how that will look. So your inventory, opening inventory, closing inventory, opening inventory 12,000, closing inventory 11,600, and then inventory from acquisition. You add. Inventory is an asset, so you work on the debit side, you add it, the acquisition inventory, and then you strike the difference, and you find out that we have cash on the credit side of inventory, which means we will debit cash. And once you are debiting cash, it means cash inflow from inventory. So cash in, cash received, cash coming in, inflow. So it is an increase in, it is a decrease in inventory, which means we have cash. Decrease in inventory, which means we have cash. So that's how you acknowledge it. You debit inventory, a reduction in it, and you credit it, and then you debit cash. So that's how you interpret it. So 260 cash inflow. The receivable, your opening receivable, your closing receivable, 94, and then the receivable from acquisition, 700, and when you strike the difference, you have cash out of 500 because your inventory, your receivable is increasing. It's increasing. You are debiting receivables, which is an increase in receivables, and therefore cash is going out. You are crediting cash, which is a cash out. So cash out of 500, cash in inventory, cash out receivable, and then your payable, opening payable, and then closing payable, and then payable from acquisition. It will increase this, the existing payable, and then when you strike the difference, you have cash. All these are T accounts. I don't think we have to study T account new. So it's an assumption that everybody can prepare a T account by just opening balance, closing balance, and figures from acquisition of or wherever you have to bring the figures from. So you have a cash, a difference of 2,200, which is a decrease in payable. A decrease in payable. So we are debiting payable and we are crediting cash. Once we are crediting cash, it's an outflow. It's an outflow. So inflow, outflow, outflow. Let's put that into our. So we have said inventory is bringing in 626 inflow. Receivable is taking out outflow of 500. Payable is also taking out outflow of how much? 2,000. How much is it? Let's look at it again. Payable 2,200. 2,009, 2,009, 2,200. So we have our cash from operating activities. Cash from operating activities is everything correct. Now let's walk through again. 1,800, 500, 500, 400, 850 addition 26, 500, and we are getting this. Let's check quickly. Everybody, acquisition is 500. Therefore, this is 10,7, and therefore this should be 2,000. And so our payable will be minus 2,000. And therefore we have that. Then the interest paid, if you remember, 850. I showed you where I got it from at the beginning of the recording. So you look at it again. And then, this is interest on loan, 850. And then the tax, we prepare T account for tax, and you go for your opening tax. Okay, tax liability provision. So from the current liability, balance brought down 900, balance carried down 600. Tax from no, this is not acquisition, this is from, sorry, this is tax from consolidated statement of profit or loss. Tax from the profit or loss is 600, and so if you strike it out, your tax paid is 900, and so we insert that here as 900, and therefore your net cash flow from operating activities will be this minus that minus that. That should give you that. Okay, then PPE, you must prepare a T account, opening balance of PPE, closing balance of PPE, and acquisition. So let's see. We have PPE, opening balance of PPE, closing balance of PPE. The depreciation is a reduction from PPE, and the acquisition, 800 from PPE. You have cash outflow, cash outflow, because PPE has PPE has increased. If it has increased, then we paid for more and therefore we credit cash. And so it's a cash outflow. Investment, an asset, opening balance of investment, closing balance of investment, then the share of investment in associates, the 500, and therefore if you strike the difference, you are getting a inflow, cash inflow of 300. We have received dividend from investment of 300. So same rule for share capital. Our share capital opening balance equity is 10,000. The closing balance is 14,800. Now, acquisition, we issued shares for the new acquisition 3.6, and therefore if you add that and you compare with the closing, you get a difference of 1,002, and that gives us our cash inflow. We are crediting share capital, we are debiting cash inflow of 1,002. Retained earning, your opening retained earning, your closing retained earning, then attributable to parent from profit or loss. Profit for the year attributable is 1,002, and therefore if you prepare your T and strike out the difference, you should get your cash of 200. The T account is your solution to everything, and you must know where to get your figure from. That is the most important. NCI, opening NCI, closing NCI. Now you are getting NCI for profit or loss attributable to NCI. That's 190. And then the acquisition also brought NCI 10% of the net asset, which is 340. And so again, just striking the difference, you have cash of 130. And so these are the T accounts you prepare for the to support the financial statement. You don't have to prepare T accounts for everything actually. Some of them you can just do them in brackets, but that is something you do when you master what you are doing. So for me, I'm using T to explain the concept for you. If you practice, you know how to do it and do the statement form. I will normally do statement form, so you know what I mean. So from the T account of the PPE, we had a cash outflow of 200. From the T account of acquisition of subsidiary, the parent paid 460 cash, but the subsidiary came in with cash of 200. 460, and came in with cash of 200. So the net cash is 260. And then from the investment in associate account, we received dividend received of 300, the T account. And then when you come to financing, the share capital gave us 1,200. If you are in doubt, prepare your T accounts. Dividend, the parent paid to its shareholders from preparing the retained earning account, opening retained earning, closing retained earning, attributable to parent. That gives you a dividend paid of 200. It was paid, cash outflow. And then NCI, opening NCI, closing NCI. NCI from profit for the year, and NCI from the acquisition give us dividend paid to NCI of 130. And the loan repayment is a movement. The opening loan is 18 million, the closing loan is 14 million. So there is a loan repayment of 4 million. And this, from financing, you are getting this, and from investing, you are getting that. And therefore, your total, so this is net cash flow from financing activities. This is net cash flow from investing activities. And then we have net cash flow from operating activities. So when you put all the three together, then you are getting net decrease in cash flow. And that is this plus that plus that. So you see, this 2007 that I showed you as a movement. So when you bring in, when you are reconciling, then you bring in the opening cash and cash equivalent. That was for 100. And so if you add that, you are going to get your closing cash and cash equivalent, which is 1,004, which is equal to the closing cash and cash equivalent. So, guys, that is how your consolidated statement of financial position will look like. Look, everything depends on your ability to know what to do with the figures from the statement of financial position, the movement in every item, and how it will be reported in the statement of cash flow. You must know that you have three headings. These three headings, where do you get information from? And I have explained your profit and loss and movements in the assets, the current assets and current liabilities, and some of the PP item, the non-current asset item, will feed into your operating activities. Investing activities is about acquisition and disposal of non-current assets, and then financing activities is about the raising finances either through equity or through loan, and all the associated interest and associated dividends that come with it. So you need to practice. It is practice. Go through all the questions I gave you, work through them, just get used to it, and you are good to go. Thank you.